Okay, welcome everybody. We're just gonna wait a minute or two until we start our introductions, but thank you for joining us on our webinar. This is a webinar between Millcreek Commercial and Southern California Exchange Services regarding what you need to know about 1031 exchanges, and we're excited to meet with you today. As people are kind of trickling in here, we just want to remind you that the first portion of this webinar will be sort of a discussion between Millcreek Commercial and Southern California Exchange Services. And then towards the end, we will have an open Q&A, and you're welcome to submit your questions. The best way to do that would be through the Q&A feature. We'd encourage those jumping on to not submit them via chat. It's a little bit easier to answer them if they are put directly into the question and answer feature of the webinar. So we'll repeat that once more once we're ready to get in and into things, but we'll be starting that in a minute. One that's already here and joining us. All right. I'm just going to start with a very brief introduction. Welcome to our webinar. This is a webinar covering the basics of 1031 exchanges and how they'll benefit clients. We're so excited to have everybody that's jumping on today. We have here with us Millcreek Commercial and Southern California Exchange Services are going to be hosting this webinar. And we're so excited once again to have everybody here. For those that are jumping on and joining us just recently, I'd like to remind you that the second portion of this, or the second half of this webinar, will be a question and answer. And we'd love to have your interaction and engagement with your personal questions for our guests and hosts today. If you could, please submit your questions to the question and answer feature of the webinar rather than the chat. That will help us take care of all the questions in one spot. But without further ado, I will turn the time over to Spencer Taylor and Megan Destito, who will be running this webinar. And Spencer, take it away.
Hey, thank you, Parker. And thank you all for joining us. My name is Spencer Taylor with Millcreek Commercial, and we are excited to have a guest on this webinar, Megan Destito. Megan is the owner and operator of Southern California Exchange Services out of Ventura County, California. Megan is all about customer service. She loves serving her clients and she loves educating people. So check out her Instagram page, SCES1031 on Instagram, and enjoy all the wonderful content that she puts out that's educational, entertaining, and just great to consume. So Megan, thank you for joining us. It's so great to have you here.
Thanks. I appreciate the opportunity for sure.
Before we dive into this topic of kind of the basics of a 1031 exchange, tell us a little bit about yourself. Tell us, why do you do what you do? Why are you working in this field of doing 1031 exchanges? I don't know of a single little girl who ever wished upon the stars that she could grow up and work in 1031 exchanges. So tell us, why do you do this work?
Well, it's actually an interesting story. So I started doing exchanges right after I graduated from college, and my degree was marine biology. All right. So I moved out to California thinking I'm going to get this great job working with whales, my dream. And I got a job working for a husband and wife. The husband was the attorney and the wife did the exchange industry. And so I didn't know what the heck these were. And so she even asked me, what do you want to get paid? And I'm a kid, I didn't know. And it was after the first week, I went back to her and I said, this isn't a job, this is a career. This is really, there's so many different parts and layers of a 1031 exchange, and I'm using my brain all the time, and it was challenging. So I'm constantly learning. And if something catches me up, I'm like, ooh, I'm going to have to ask somebody else that might possibly even know more than I do about exchanges. So I've always really been fascinated with exchanges. And then I'm really good at it too. So it's just the whole picture. I just really enjoy the conversation. And now that I'm older, I really enjoy educating people and making them feel comfortable and knowledgeable in the process, because I feel like once you talk to me, you have a really good understanding and you're like, oh, it's not as overwhelming or as difficult or daunting as I'm being told out through social media. So
yeah. Well, good. Well, we're excited. Let's dive right in and get
okay.
to it.
Perfect. So for me, I do not talk, I don't read the statute to people. I will lose all of you in literally 30 seconds. So I am more of a nutshell version. I simplify it, I break it down. So like I said, once you leave this webinar, if you've never done an exchange, you'll feel comfortable that you can do an exchange. And if you're a realtor, you'll feel knowledgeable enough to be able to talk about a 1031 exchange with your clients. So with that being said, there we go. What is a 1031 exchange? Okay, in the eyes of the IRS, a 1031 exchange allows a real estate investor to defer paying capital gains tax as long as they're on the sale of their investment property, as long as they're reinvesting those monies into another type of investment property, and that's done within a specific period of time. So you'll hear the phrase like kind, like for like. What does that actually mean? And we're not talking condo for condo or house to house. What that means is, how is this investment property, or how is the property being used versus what actually is it? And so what qualifies as a like-kind property is a single family residence, a condo that you're renting, a house that you're renting, an Airbnb, a short-term rental. Those type of properties qualify because they're bringing you income. A duplex, even if you live in one side of the duplex and you rent out the other, the portion that you are renting out qualifies for exchange treatment. Vacant land, that qualifies, especially the vacant land that you're going to be using to develop and build an investment property, that qualifies. Commercial real estate. When I started doing 1031 exchanges back over 22 years ago, the IRS had just figured out and defined how you can allow multiple investors into one piece of commercial real estate, and that becomes affordable. This is what Millcreek specializes in, as affordable pieces of real estate for mom and pop investors, or even the most savvy investors, and it's passive income. Like commercial real estate is a really amazing option, and the way that they're structured meets all the requirements for 1031 exchanges. Farmland, that qualifies. And then there's some other less common ones that do qualify. 30-year leasehold interests, oil and mineral rights, which I feel like that's starting to creep up and become a little bit more popular. And then there are certain types of securitized real estate transactions that qualify and others that don't. So the ones that do qualify, which you might have heard, are Delaware statutory trusts, which are also known as DSTs. I want to be very clear about what does not qualify. And what does not qualify is your primary residence. If you are reporting the property that you live in as your primary residence, that does not qualify. That is a completely different section of the statute. And so you can rent out a portion of your house. Maybe you have a granny flat in the back, then that portion would be available for the benefit of the 1031 exchange, but the rest of the house would not. Property that's held.
One quick question on that. Okay, first off, recommend that you always talk to your CPA and attorney if needed, right? So with like a mother-in-law apartment or a duplex, you're living in one side, renting out the other. It's almost like the mother-in-law apartment is 15% of your total square footage, right? So you can exchange 15%, right, of the proceeds. Is that kind of how the IRS sees it?
Yes, it's about how you're reporting the property. So if you're renting out a portion of your house, then your accountant is saying, okay, so based on the square footage versus the rest of the house, that's like 0.925%
Yeah.
of the property that's making you money. And so then that's how you would set up your exchange, is I'm exchanging 0.925% of this address.
Mhm.
And it has a value associated with that basically you are figuring out with your accountant. Yes.
I mean, basically, like a nugget here, ask a question, right? Ask your CPA, ask your qualified intermediary, call up Megan and ask her.
Well,
And,
I also want to tell you that I'm not a tax advisor.
Sure,
So
sure.
I specialize in 1031 exchanges, but I'm not available to give you tax advice. Like, you have to seek the advice of either an attorney or an accountant and come up with those numbers outside of my company.
Yeah.
So that's very important. So thank you for bringing that up.
Perfect. Thank you. Thank you, Megan.
Yeah. And other properties that just don't qualify as properties that's held for resale, those are people who are flipping real estate. So they are in it for a quick profit. And in the eyes of the IRS, they are not an investor. They're not a long-term investor. What they are is a dealer. And so they don't get the benefit of a 1031 exchange. Vacation homes, or second homes, if you're using them for personal use more than 2 weeks out of the year, which is an eye roll, they do not qualify for exchanges. Stocks, bonds, mutual funds, those are not tangible real estate. They do not qualify. And then REITs, it's a securitized real estate transaction, but the way that they're structured is not an option for 1031 exchanges. So who benefits from a 1031 exchange? The benefit goes to the people, the investors who are in it for the long haul. So like I said before, the people who are flipping real estate, they're short term. They do not get the benefit of a 1031 exchange. But what defines long term? So there have been enough case studies by the IRS that says if you have reported your property as an investment property for at least 2 tax periods, that would suffice as being long term. So you want to make sure that the property that you're selling or exchanging out of, you've held on to that property and reported it as an investment property for 2 tax periods before you decide to do a 1031 exchange. And you want to make sure that you're doing the same thing with the purchase property. You want to make sure that your intent is to buy this property and hold on to it for long term for at least a minimum of 2 tax periods before you decide to do another 1031 exchange with that property. So this is what I find very interesting in the social media world, is that you hear a lot about 1031 exchanges, like who's doing it, the benefits of doing it, but you don't know why you have to use somebody like myself. I refer to myself as an exchange accommodator. Other people call themselves qualified intermediaries or QIs. It's one and the same. So when you're using an exchange company or an exchange accommodator, first of all, they cannot be related to you or to the transaction. They have to be completely arm's length. You can't have a relationship with that person for the last 2 years. So your realtor could not be your exchange company. Your best friend, no. Your family member, no. They cannot do this. It's defined by the IRS that you have to use somebody who's completely neutral to you and to the transaction. So but the exchange company has to have specific verbiage in place that's outlining the role of myself as the exchange accommodator, but it's specifically outlining the role of you, the exchanger. And so what I feel that most people don't fully understand is that when you're doing an exchange, you're actually giving up your interest in the property and you're giving it over to the exchange accommodator. So the paperwork and the meaning behind the paperwork is if it's a photographic moment of close. All right. So I'm coming in on your behalf and I'm saying, okay, John, you as the seller, I'm basically going to deed the title, take the deed from you, and I'm going to hand it to the buyer. But in doing so, you're going to hand me the proceeds. So you're not going to have the benefit of those monies. And by not having the benefit of those monies, you're going to defer paying tax. And what I mean by benefit is you touching the money. So if you're actually touching your money, You're paying tax on the money. So by avoiding touching the money, you're avoiding paying tax. That's about as basic as I can explain it. So you want to make sure that your accommodator has that proper paperwork in place that's outlining it and telling your closing officer, this is what's happening, okay? And your closing statement will say hopefully it says Southern California Exchange Services for the benefit of John Doe as the seller. And then on the purchase, it will have something along the same lines as the buyer. So I hope that's clear. And in addition, I'm coordinating with all parties of the transaction. Hopefully I'm coordinating with your accountant or your attorney ahead of time so that we're all working together to make sure that you're meeting your real estate and your financial goals so that we're crossing all the T's and dotting all the I's and meeting all the requirements within your 1031 exchange timeframe. So the main benefit and why everybody I feel wants to do a 1031 exchange is to obviously defer all of the capital gains tax. So an exchange isn't an all or nothing transaction. You can exchange as much as 100%, or you can exchange as little as you want to. It just depends on what your financial goal is, okay? But if you want to defer 100%, then you want to make sure that you're following every single guideline to a T. And the first one is that you're purchasing a replacement property that's equal or greater than the value of what you sold. That's number one. And the second one is that any of the monies that the exchange accommodator is holding for you, those all need to be reinvested into the purchase. You want to make sure that you're identifying in writing what it is that you're buying. A contract suffices as being in writing, but you want to make sure that you're doing that within a specific window of time, and that's 45 days from the day that the sale closes. And I'm going to go into depth on that in just a second. You want to make sure that you're also purchasing the replacement property within 180 days, and that's from the day that the sale closes. And the main one is that you want to make sure that the entity, the taxpayer that's on title to the sale property, is the same entity and taxpayer that's on title to the purchase. And there's some caveats with that. So an example I like to use is that you're selling the property and the property's in the trust. And the husband and wife are trustees of the trust, which in the eyes of the IRS, it's the same taxpayer. So you're selling your property, and then now you want to buy a replacement property. Well, most lenders don't lend to a trust, but they'll lend to a husband and wife. So that's okay. So you'll purchase the property as a husband and wife and close on that transaction. And once it's closed, then the husband and wife will quit claim their interest back into the trust. And in the eyes of the IRS, that's one and the same. It's totally doable. Where it gets tricky is if you're in a partnership. And so you and your partnership are getting rid of the property, but you don't want to buy in the partnership. You want to buy as an individual. So you'll want to make sure that you're working with your tax advisor ahead of time to possibly be dissolving your interest from the partnership and taking on undivided interest as John Smith, John Doe in the sale property. You both can be selling and exchanging at the same time. It just means that now John, instead of being in the partnership, John has an undivided interest in the property. I'll say it's 50%. He's exchanging 50% of the property. And now John Smith is free to buy anything that he wants on his own to satisfy his exchange. So, and back to trying to defer 100% of the capital gains tax, you're looking at three factors. The first one is value, the second one is debt, and the third one is cash. You want to make sure that all three of those factors are equal or greater in the purchase in your exchange, and that's to defer 100% of the capital gains tax. I like to use very generic numbers. So you're selling $1 million property, you're paying off a $500,000 loan, and your exchange accommodator has $500,000 in proceeds. In order to defer 100% of the capital gains tax, you want to buy another property valued at $1 million. You want to take on a new loan of at least $500,000. And then you want to make sure that your exchange accommodator is wiring the $500,000 proceeds into that purchase. One thing I do want to make sure that we are clear about is that you can always bring in your own money to offset your debt requirement. So in this scenario, if you did not want to take on a $500,000 loan, you can take on a smaller amount of loan. It just means that you have to bring in your own money to make up that difference. So if you want to buy $1 million property, but only take on a $250,000 loan, totally fine. The exchange accommodator is still wiring in the $500,000 of proceeds, but now you're wiring in $250,000 of your own money to that closing transaction to make up that difference. And so what you don't want to do if you're trying to defer all of the gain is that you don't want to take on too large of a loan or maybe buy down in value, because now you're pocketing some of those proceeds from that the exchange company was holding for you. And because you pocketed that, you touched it, and now it's taxable. So every exchange has its own timeline, and that timeline begins the moment you sell that relinquished property. From that day, you have 45 days to identify replacement property, and there are no extensions. So it's 45 days from that day. It's a very small window if you don't know how you're going to reinvest those funds, okay? So it's a letter. It's a contract. It's properties in writing that you would more than likely, you would give it to me because I'm handling your exchange, but it has to be in my file by the 45th day. If I have nothing from you by the 45th day, your exchange is over on the 46th day. It's as if you never even entered into a 1031 exchange. Full recognition of the capital gains tax. So this letter is absolutely important. It's the most important, I feel, part of the 1031 exchange. So let's just say hypothetically, you are in contract, or you do, properly identify the replacement property. Then you have an additional 135 days to purchase something from that list. So it's a total of 180 days. The 45-day guideline, like I said, it's specific. So the letter is from you, it's date stamped, it's signed, it's listed by priority, and it's one of 3 guidelines. So my general rule of thumb with my clients is try to identify up to 3 properties. You can interchange that letter in and out up until the 45th day. So try to keep it within 3 properties, because if you identify more than 3, then you have limitations. If you keep it within 3, there is no limitation on the value of the ones that you're identifying. And you have to remember that you're picking one of these 3. So if you decide to choose to identify beyond the 3 properties, then you either fall on the 200% rule or the 95% rule. And the 200% rule says that you can identify any number of properties as long as the fair market value of the properties that you're identifying does not exceed 200% of what you sold. So if that doesn't work out for you mathematically, then you fall into the 95% rule. And the 95% rule says that you can identify any number of properties beyond the 3, as long as you purchase at least 95% of what it is that you identify. And I feel like with this identification letter, the main reason that you have it in the file is to show intent. It's showing that you have every intention to satisfy your 1031 exchange. You're telling me as your exchange accommodator, but most importantly, if you were to get audited by the IRS, you're telling the IRS that I'm doing everything I possibly can to cross my T's and dot my I's to make sure that I'm buying another investment property.
Hey, Megan, quick question, because I think the identification is interesting. Three properties, and each of those 3 properties can be 100% of the value of the exchange, right?
Yes.
The 200% rule, just give a little more context on that. Who would like usually use that? Kind of, what are they exchanging out of? What are they exchanging into? And maybe also the 95% rule. What are they exchanging out of? What are they exchanging into? What have you seen? Because I mean, not a lot of people, at least that we work with, kind of tinker around the 200% rule or the 95% rule.
And that's mine as well. That's my experience as well, that my clients can definitely, knowing that they can interchange the letter with the 3 property rule up until the 45th day. Yeah. I honestly, I don't think I've ever had a 200% rule or a 95% rule. Unless they know that maybe they're buying 5 different pieces of commercial real estate, or 5 different DSTs where it's all these different percentages. And so it boils down to whether they're buying equal or greater in their exchange. So if somebody's buying just straight across the board and they know what they want, of course, they're in the 3-property rule. But I think that if they know that they want to really diversify their real estate portfolio, then they would probably be in the 200% or the 95% rule. But that is so few and far between. And I mean,
kind of in my mind, if someone's selling like a 500 unit apartment complex and they want to buy strip malls instead, like maybe get out of the multifamily. And so they would identify, I don't know, 50 smaller commercial or 50 smaller multifamily. That could be like the 95% rule, where you're
right.
going from one big asset
Sure, to multiple
smaller ones.
Yes, that's when I mean, granted, my experience is not to that level because I'm definitely more mom and pop investors. That's my bread and butter.
But that's tough, right? Because you're selling a huge property and you're trying to get under contract a whole lot of little ones. I mean,
right.
A lot of things like everything has to go right in that scenario for you to defer all taxes.
Right. And that's, I mean, I hope that they are working with their tax advisor and they're crunching the numbers, you know? So.
But most use the 3-property rule, which is
yes,
kind of across the board.
Yes.
Yeah.
I feel. These are really the top 5 questions that I get from my clients. And the first one is, can I take money out of the exchange? And because you're not supposed to have benefit, you get no access to those monies. But there are 3 points in time in the exchange where you do get your money. And so the first one is on the 46th day. So that means if you did not identify any replacement property, then all of your money is coming back to you on the 46th day, and you have your full recognition of the capital gains tax. The second one is if you are purchasing a property, maybe you're buying down in value and you have money left over, but you know that you don't want to continue on with the exchange, meaning that you just want that one property, you know you're going to have a taxable event. And so I would basically refund the remaining portion of the exchange proceeds at that purchase transaction. What I like to do, just so it's a clean monetary paper trail, is I would wire everything I have. And I would wire everything I have for you to that closing transaction. So it shows up on the closing statement. And it also shows the refund going directly to you. So that's how I handle that. And the third point in time is if on the 181st day, as if you never bought a replacement property at all to satisfy your exchange, then now you get all of your money or the remaining money on the 181st day. But in between then, you do not have access to the money. I do have clients that say, hey, I just got in contract. Can you send an earnest money deposit? I can do that. I just need to make sure that I have that documented. So monies can go towards a purchase transaction. They just cannot go to you directly or to anything outside of a purchase transaction. Do the sale and the purchase have to be the same type of investment? No. Here's another benefit of a 1031 exchange is diversifying your real estate portfolio. You can go from a condo, go into a house. You can go from single family residence into commercial. You can go from single family residence into commercial and residential. It's just, there's so many different ways that you can structure a 1031 exchange. It allows you to move to different markets, to different states. I mean, it's a federal statute. You can go across state lines. There's just, that's the part that excites me, is how many ways that you can structure a deal and increase your monthly income stream. It's just, I love it. So can I buy or sell multiple properties? Absolutely. And I feel like we brushed on this. You can sell one property and buy multiple properties. You can sell multiple properties and buy one property. Again, it's all in how you just want to make sure that the numbers work. So if you're selling one and buying multiple or vice versa, you want to make sure that the value on all of those, if it's multiple properties, the value of all of those in that one exchange file meets the requirements on the replacement property. So if you're selling 3 properties, what's the value of all 3 of those properties, and you're buying just one property, does that one property equate to the same value as all 3 of those, or is it greater? So you want to make sure that you're crunching numbers if you're buying or selling multiple properties. Do I have to buy or sell 100%? of either property? No. So like I said before, you could be in a partnership or just own an undivided interest in your sale property. You can exchange 50% of a property over here and buy 100% of a property over here. You can exchange 50, and you can, if you're buying multiple properties, just like if you were buying something probably with Millcreek, you could have a separate undivided interest in multiple commercial real estate properties. So again, it's, do the numbers match? Are you buying equal or greater than what you sold? What happens, and this I feel is really important, especially in this market. What happens when I identify replacement property and it falls out of escrow and I'm past my 45th day? It's a tough one. And this all boils down to intent and your clear paper trail. So I have clients where this has happened, or they're so afraid that they're submitting offer after offer and they keep getting rejected and they're creeping up on their 45th day. What do? This is what I tell them, is that I need to have something in writing by you, and you need to have a clear paper trail. So you need to prove to me and to the IRS, if you were to get audited, why you're doing what you're doing. Okay, so, and what I mean by that is if the IRS were to audit you, and I should just say that by doing a 1031 exchange, that does not raise a red flag to the IRS at all. But if they were to audit you, they would say, okay, so let me see how much did you sell? Let me see the closing statement. Let me see your identification letter. Do you have one? Okay, and let me see the closing statement on your purchase property. Does the purchase property address match something that was on that identification letter? And if it doesn't, they could completely overturn your exchange just for that reason alone. So if there is a reason, do you have a paper trail to show that reason? You could say, yes, I've been writing offer after offer. They keep getting rejected. I have every intention to purchase a property and hold on to it long-term as an investment to satisfy my exchange. So yes, I did this because of this. And that would be a clear paper trail. Now, could the IRS still overturn your exchange because of that? Yes. So are you running the risk? Yes. So there is a risk involved if you fall out of escrow past your 45th day and you decide to purchase something else. You can do that, but you run the risk.
I mean, Megan, it might be helpful to talk about safe harbor, right? Safe harbor is the 45-day rule, is the 180-day rule.
Yes.
And outside of safe harbor means it's not like an automatic green light, check the boxes checked, no further questions needed.
Right.
Outside of safe harbor is maybe a little bit of investigation, figure out what's going on. I love this example of, starting on day one of your 45-day ID, your offers are submitted every day, and you just get rejected, right?
Mm-hmm.
And I think that is a clear indication of intent. And Megan's pointed this out. Our intentions matter a lot in the eyes of the IRS.
Right. So they definitely want to know that, what's your plan? As long as you're, I should just leave it there and knock on wood.
Period. Put a period there. Yep.
Yeah. Right. Yep. So, yeah. So I feel like that pretty much covers the nuts and bolts of a 1031 exchange. These are different ways that you can contact us or me. So I'm open to any questions.
I think before we jump into the questions, Parker, and we'll have you monitor those, I think like preparation will get you ahead, right? So if you know you're going to sell a rental, start looking for that replacement property right away and start organizing the exchange before you're under contract even, right? Connect with your QI, call your CPA, call your attorney, call your professional team and say, hey, I'm thinking of selling this rental, this duplex, this fourplex. I would like to do an exchange. Can I just get tips from everyone? Can I just, teach me a little bit? And I'm going to start like looking and thinking more seriously about what I want on the replacement side. And earlier the better, right? Planning is earlier the better, so that 45 days doesn't run out. It goes faster than
It's like a blank. Yeah, it feels like a blank. And my husband and I just did a 1031 exchange, and we had an Airbnb out in St. George. And based on how much we made on that money, we're like, well, we should let's capitalize on this. So we were kind of money driven, but we're also tax driven. And so I kind of see it from both sides. Yeah. So just from my experience, we kind of jumped into it, and then it was like, oh gosh, now I have to identify replacement property. What's it going to be? And I do this for a living, but when it's your own stuff, you kind of just get overwhelmed. Right. So it's that 45-day window, speaking from experience, it causes a lot of stress. So yes, Spencer, it's best to have a plan and have an idea of where you're going to invest those funds before you list your property and enter into an exchange. Absolutely.
Okay, Parker, let's open up the Q&A, and then Megan and I can just kind of tag team these questions. If you have more questions, please submit them. We'll stay on as long as there's questions. So our time is yours, and let's just dive into these.
Perfect. Before I go into the questions, I just wanted to do a quick little announcement that this webinar is being recorded, and you can access the webinar via a link that will be sent out to all that have registered by the end of today. So just so that if you've jumped on late or just getting to the discussion, just know that that's going to be available. But without further ado, we'll jump into the questions. So the first question that has come through is from a listener named Trish. She said, her question goes like this. She says, if you're doing a direct party exchange, do you need an intermediary? She clarifies by saying, I understand why you need an intermediary for a delayed exchange, but if two parties are exchanging with each other with no additional legs, is an intermediary required to qualify as a 1031 exchange?
Yes, because you have to have the verbiage in place. Oh, sorry, Spencer, did you want to?
Well, I think what she's asking is, if I have a house, Megan, and you have a house, and you like my house, my investment property more than you like yours, and I like your investment property more than I like mine, can we just swap deeds?
That's really how
that's kind of what she's asking, right?
That's really how, that's like the Starker exchange. That's the scenario on how this all started, is basically it was an even exchange. And so, I mean, that's really, there still needs to be documentation in place that's what, I mean, because if you were to get audited by the IRS, where does it show that you did it in exchange?
Yeah.
How did the money exchange hands? There still needs to be a clear paper trail about that. So I would make sure that you're still using an exchange company to make sure that you're doing all of those things if you were to get audited.
Even if person one signs over the deed to person two and person two signs over the deed to person one?
Well, I mean, I think so, because I mean, you don't have somebody doing that on your behalf.
Right.
I'd love to hear your thoughts about that. So,
I mean, I don't know the legalities of it. I think call Megan, ask questions, and see. I also think, property for property is kind of like back into the barter system. I don't think most people would ever do that, maybe except for farmers, but just because, I don't know.
Well, even with that, you have the that's me going out.
There's a lot of different factors. So
it's like, are the values the same as the property? Does the property qualify? Right, There's so many different parameters within that scenario that I would have a lot of questions to make sure that would meet the 1031 exchange. Right. Had they both been reporting it as an investment property?
Good. Yeah. So use an intermediary on everything.
Yeah.
Perfect. I guess we'll jump into the next question. And these are from our Q&A panel. If you do have questions, make sure that you submit them there. The first one is more general. It says, do you do business in Texas?
Is that for me?
I think whoever wants to answer.
So, Megan, you're based in California, but can you do business in Texas?
Yes, it's a federal statute, which means that I can operate and do it in an exchange for anyone as long as they're located within the United States, or the property, is located within the United States. Yeah. Yes.
So not bound by state lines.
No.
Great.
You can have a lot of people cashing out of California and buying across state lines.
Yep. That's good.
Great. Okay, so the next question is from listener Steve. He says, if I sell a rental property in Connecticut and buy a property in Florida that I will rent for part of the year and live there for another part of the year, does that qualify?
Well, I mean, that boils back to the slide where I talked about how long, about like kind property and how you've been reporting that property, and how if you've been using it for personal use for longer than 2 weeks out of the year, then technically that wouldn't qualify for a 1031 exchange.
Megan, how could he get around this though? Is there anything he could do to turn that into a personal residence? What's the process from turning an investment and the house in Florida, you VRBO it, you Airbnb it for however long, and then now you want to turn it into for personal use?
So you can do that. That's a big wink there, because I'm not a tax advisor, but so you want to make sure that you first have satisfied the requirements of your 1031 exchange. So that means that you want to make sure that you have at least reported that property as an investment property, to make sure that the IRS knows that this has been an investment. That was the intention. Therefore, I should get the benefit of not paying the capital gains tax when I did that exchange. And so if you have held on to that property for long term and you decide that you want to convert it to a primary residence and then report it like that, you can do that. I have clients, older clients, where they basically find their retirement home. So they do that and they set themselves up by utilizing a 1031 exchange, rent that property out for a number of years, and then eventually convert it and live in it and retire.
Yeah, good. So it can be done. I just don't think it can be done the way he kind of envisioned.
The way that he asked that question, my first answer is no. Yeah. So just because of him using the property almost like half the year for personal use. So.
Well, that actually goes along well with the next question that we have. This person says, in the past, I've exchanged a personal residence by turning it into a rental for 2 consecutive years and then used 1031 exchange rules to exchange into another investment property of equal or higher value. Yeah. Do you know if this is still allowed?
Yes. So if you had a property that you used as your primary residence and then you decide to convert it to a rental and you held on to it and reported it as a rental, yes, absolutely. Then you can exchange that property. It would qualify. So it all boils down to how long would you be deemed a long-term investor at that point in time if you're trying to do a 1031 exchange. And so if you've held on to it and reported it for at least 2 tax periods, then yes, you could get the benefit of doing the 1031 exchange, as long as you're reinvesting those funds into another type of investment property.
My thoughts also go in that scenario. My thoughts go to what's it called, like the Homestead 122, where you can sell it if you've lived in it any 2 of the last 5 years. It's considered personal property, and if you're married filing jointly, you can have gains up to 500,000 that you don't pay tax on. So in that scenario, I would say, well, why do you want to do a 1031 exchange when you could sell it? I mean, unless your gains are just huge, you could sell it and it would be considered personal property, and then you wouldn't pay any taxes on anything, and you would not be bound to buy another investment property.
Yes, or in that scenario, they bought a different primary residence, and they rented out the previous primary residence and converted that into a rental property and are doing an exchange with that. And they have a separate house as their primary residence. But you are correct. I think it's section 1033, right? For your primary residence.
1033 is eminent domain.
Oh, sorry. Yep.
I thought it was 122. Homestead 122.
Yes, you're right. Yeah, where you can defer, if you're husband and wife, you can defer up to $500,000 on your primary residence if you've lived in it 2 of the last 5 years, and they do not have to be consecutive.
And just to put context on the 1033, if your property is taken by eminent domain or is damaged by natural disaster like a forest fire or a tornado, and it's an investment property, right, Megan? And it's an investment property, then you can do what's called a 1033 exchange, and you don't need a qualified intermediary, I think, on that. And you have like 3 years to figure out what to do next in terms of exchange. And I believe you hold all your own money. You just have to buy equal or greater value. Megan, is that kind of, I don't know, do you know
I
much
don't
about
even
1033?
I don't ever deal with a section 1031, excuse me, a section 1033. So I don't even want to comment on it just because I don't even know enough about it because it's not in
Ask
my
your
scope
CPA.
of,
Yeah, ask your CPA if
right,
for 1033, but
exactly.
they're pretty rare. They're pretty rare. Okay.
Okay. Moving on, the next question says, can you do a 1031 exchange to properties owned through a solo 401k?
I'll take a stab at this. Number one, there's no taxes. I mean, it's in your retirement account, so there's no taxes to be paid when you do sell, which means you can sell it and then go invest in stocks and bonds, and there's no tax consequence for doing that. Megan, am I right?
Right. I mean,
yeah. There are no taxes. You are deferring your taxes because it's in your self-directed retirement account.
Right. So, I mean, when I do the 1031 exchanges, we're talking about the actual taxpayer being the entity, not the type of investment that owns the, so for me, I wouldn't consider that a 1031 exchange. That would be in a completely different section.
Yeah.
All right. The next question says, can you exchange the property you own for vacant land and a contract to build a building?
That's a good one. So my first thought is talking about an improvement exchange, which is improvement and reverse exchanges are another webinar. So there's a way that you can buy land and build upon it and use exchange proceeds to do that. And that's through what's called an improvement exchange. Or you can just do an exchange and buy land and eventually use your own monies to build upon it. It just means that now you are adding a lot of monies to the basis of the land. Is it land value equivalent to what it is that you sold? So I would just have a few more questions about follow-up questions in regards to that one question so that I could answer it appropriately.
All right. Well, let's just jump into the next one. It says, can a corporation do 1031 exchanges?
Absolutely. So if that's the end, does the corporation also want to buy a new property? If that's the answer, then yes, the corporation is the tax entity that would be doing the exchange and the same entity that would be buying. So yes.
Just
Great.
a quick example, like I went to a conference one time and there were a lot of people there from like BNSF, like the train company. They might own a lot of land and their railroad track only covers a limited portion of their land. So oftentimes they'll want to sell, both sides that their track is on with enough room to operate their business. And they definitely were there to learn how to do a 1031 exchange because it's in the best interest of the company to reinvest that in other land or, whatever, and defer their taxes. But yeah, that was an interesting thing to see the BNSF people there learning about 1031 exchanges. So corporations do it.
Mm-hmm.
Awesome. Okay, so moving on, the next question asks about reverse 1031 exchanges. They just ask simply, under certain conditions, I understand that one can do a reverse 1031 exchange. Is that something that's possible? A little bit more information would be great.
Yes. So whenever you're doing an exchange, you always have to have a sale close first and then a purchase. But a reverse exchange would come into play where you found your replacement property and you really want to jump on it, but you haven't figured out or lined up your sale yet. So that's really when it would come into play. And so you can do that. It's convoluted, it's complicated, but it's streamlined and it's doable. In a nutshell, you would loan me. I would set aside, I would create a disregarded entity, an LLC that's has zero assets to it. It's merely taking title to property. So you would loan me, my LLC, the money to buy your replacement property and hold on title to it for you. It's not, you don't have an exchange at this point. It's just my SCES reverse 3 LLC that's holding title to this property. You loan me the money to do that. We have an agreement, and I don't want anything to do with this property. So you're the property manager. We have a loan in place, a promissory note. We have all documentation that outlines the relationship, right? Now you can sell your relinquished property like you normally would, directly from yourself to the buyer. And then you'll use those monies to then set up your purchase, which would be you buying the replacement property from my LLC. And by using those monies, you're actually paying, or you're paying yourself back, really, for loaning me the money to buy that property for you initially. So what you have is, now you have a sale, and then you have the purchase, and the purchase is basically you buying a property again. But yes, it is doable. And I feel like the way the market's shifting, that reverse exchanges are going to become a bit more popular. So
I think somebody would want to do a reverse exchange if their dream property became available, and they had to jump on it quickly, and they had to move quickly because they're going to lose it.
Yes.
Then they do exactly what Megan described. And now they own it, and now they figure out, okay, what asset am I going to sell?
Yeah.
To complete this exchange. That's kind of where my mind goes on why somebody would want to do.
Yes.
Exchange.
That's pretty much, you pretty much nailed it. And the hard part with a reverse exchange is the financing, because I'm not getting the loan, and my LLC is worth zero. It has no asset. So if you need a lender, then the lender has to know that you are guaranteeing the loan, but the loan needs to be in my LLC's name. So you can't just go to the bank and say, hey, can you help me out? It's a specific product that the bank creates.
Yeah. Good insight on that, Megan. Good.
All right, so the next question asks about recent legislation about 1031 exchanges. Is there an opinion on, are they at risk of going away? Will they be in continuation? What do you guys weigh in on that?
I feel like this is a whole other webinar. I do. So this is my feeling. They're always at risk. It's always been at risk since I've been in this industry. And there's so many organizations like the FEA that are lobbying to keep the exchanges because they're so valuable. And I just feel like the government doesn't really truly understand how much money circulates in the exchange industry and how it keeps the economy, even at a local level, going. And so, but my gut feels that they'll never be done away with, because I feel like the government is doing exchanges. Like, they own so much property. Why would they want to risk their own gain? That's just me.
I think some politicians hear, oh, someone's not paying taxes. Good. Okay, good. I'm going to look into this.
Right.
Oh, they did an exchange. Great. Okay. Let's nip that in the bud, right? Like right away. And then organizations like Megan mentioned, the Federation of Exchange Accommodators, the National Association of Realtors is a big lobby group that protects this. And then they learned that, okay, they would never sell the dilapidated property if they couldn't do an exchange. Good. Now someone comes in, buys the dilapidated property, and what do? They fix it up.
Mm-hmm.
They re-roof it. They change the plumbing. They put a little lipstick. They change everything, right? They make it so somebody else would want to buy it, right? They change the landscape, right? And so now you have something that was bought for a bargain and sold to defer taxes. Everyone is happy, and it stimulates contractors and plumbers and
the amount of jobs that comes out of a 1031 exchange is significant.
And all the local taxes and federal taxes that are paid because everyone's kind of earning money in different ways. Okay, that is like the real impact of removing the 1031 exchange. It's not the 12.5% to 25 to maybe 30% based on his capital gains that he would have paid. I mean, tax revenue is exponentially bigger because he sold it to somebody and they fixed it up, and now he's buying something else, and there's just a lot of like what do you call it, unrelated but related work that is done and monies that are earned, value created because he didn't exchange. Anyway,
Right, I agree.
long answer to a short question.
That's okay. Okay, next question says, do you consider the value of the sold property of your equity in the piece of property that is the taxable equity or gain as the value or a retail market value in the exchange? Let me know if I need to read that again.
What I view as the value is what's shown on the closing statement. So it's a contractual price that you agreed upon. That's the value that I'm talking about. And so when you're looking to purchase a replacement property, it's really that value less the closing cost, like less if you're talking about like nitty gritty, in order to really calculate your taxable event. I feel like that's it. Am I understanding that correctly? Do you think, Spencer?
Yeah, it's whatever you sell it for. That's the value, whatever you sell it for.
Right.
Minus certain transaction costs. There's other line items on there that Megan can talk to, like prepayment of taxes and different line items that are expenses but are not considered part of the transaction, right, Megan? Like, yeah,
it's usually like I usually say it's the non-recurring closing costs.
Yeah,
like that's usually
like if you need to pay off a water bill or pay your taxes or pay whatever, most a typical transaction costs or commissions, anything to do with the closing,
right,
like the title work,
loan fees, title fees. Yes, those are deductible, but the other expenses would technically not be deductible. So
but the value is whatever you sell it for,
right,
whatever someone buys it for.
Right.
Cool. Okay, so this next question is about the 200% rule. They kind of present a situation by saying, maybe a client has $1 million debt-free 1031 property, but wishes to exchange up to a max of $2 million in property with $1 million of debt. Is that a correct use of the 1031?
Yes. So if they sold $1 million property free and clear, that means that if there were no closing costs, then they netted $1 million. And so if they were to buy a property that's for $2 million, then they would meet the value and they would meet the cash requirement. They had no debt obligation because they had nothing paid off. So if they took on a loan to meet the value, they could do that. Absolutely.
But for the 200% rule,
I don't know why the 200% rule was part of that question.
It's probably if they want to sell one property for $1 million and buy 6 vacant lots that total $2 million, right? I mean, because that's more than the 3, it's more than the 3 properties listed.
Right.
So I think the 200% rule would be used if you identify 6 lots, total value 200% of the $1 million or $2 million,
right?
And then you end up closing 1.4 million of those lots. That's in my head. That's kind of where the 200% rule would be used.
Yes,
You're going from 1 to multiple.
More than 3. Yes.
More than 3. Yeah, more than 3.
All right. Awesome. This next question asks, and just to maybe see if you could touch on financing. So it says, can you do a 1031 exchange and finance a portion if funds do not suffice price of properties?
Can you do it? Can you repeat that again?
Yes. Let me just go down. Okay, yes. Can you do a 1031 exchange and finance a portion if funds do not suffice price of the properties?
So I think what they're asking is, okay, I have $1 million in my exchange, all equity, and I want to buy something for 1.5 million.
Mm-hmm.
can I use my million as like the down payment and get a loan for 500,000?
Yeah, I mean, that was kind of like the scenario we just discussed,
Yeah.
you know, with a 1 million property valuation going into a $2 million property. So yes, you can, if you have no debt obligation and you're trying to find meaning that you never paid off a loan in the sale, it was all just equity, and you're buying a property that's equal or greater, but you don't have the additional funds to bring in, yes, you can take on a loan and that financial obligation, and that would satisfy your exchange. You just want to make sure that your value, if you only have 2 of the 3 factors on your sale, that those 2 factors are equal or greater in the purchase. And so the one that you didn't use, which was the debt, if you're taking on debt, that's okay. I hope I'm clear about that.
Yeah.
Cool. Okay, so this next question is a little situational. It says, can a business partner sell me 50? Okay, let me start over. Can my business partner sell me his 50% share of our commercial investment property and then use his proceeds in a 1031 exchange to buy another investment?
You broke up a little bit there, so I didn't quite understand.
I'll start from the beginning. This person asks, can my partner sell me his 50% share of our commercial investment property and then use his proceeds in a 1031 exchange to buy another investment?
So use his proceeds. So basically the proceeds from the 50%.
Mm-hmm.
Yeah.
I think so.
Yeah. So if you basically own together, you own 100% of the property, you have 50%, your partner has 50%. He's going to sell or exchange. You're going to buy his 50%. He's selling his 50% to you. Yes, you can do that. And use those monies. Hold on.
So it's like
you would have to be selling it.
If
your purchase.
If together they own
100%.
inside of their company a commercial property, right? And one of the partners says, okay, I want to go out and diversify, buy me out of this property, give me my 50%. I'm going to go buy a rental, right? Or I'm going to go buy a farm. Can they do that? And my thought is, okay, well, it has to be the same taxpayer, but there's kind of ways around that with the drop and swap. There's strategies around that. But I think in theory, they would just have to follow a couple different rules to make that happen, right? Right.
I mean, because you have the partnership issue,
partnership.
So that you have to figure that out. And then just because if he's buying you out, yes, you have to figure out how. Yes, we have to work on the partnership issue first and clarify that in order to figure out how you can proceed in the exchange, with the taxpayer entity. But yes, you could technically do that because the ownership, the 50%, is attached to that percentage of real estate property.
Now,
so that would be
that's a different question if 2 people own the property as tenant in common, 50-50. That's a completely different issue. That makes it a lot less complicated.
Right.
One tenant in common buys out the other.
Right.
Basically, one sells his interest in the same building to the other.
Right.
Then he can easily go do an exchange into another building.
Right. But in this scenario, they would have to either dissolve the partnership or talk with a tax advisor on how to basically, move to individual ownership.
Yeah.
If they don't want to be a partner together in the purchase.
Right. So on that one, I'm just going to say,
talk with your tax advisor.
Call up Megan, and she can kind of walk through kind of the specifics on that.
Yeah. And partnership issues just get so complicated. They really do. You really have to have a team of advisors. That's with myself included.
Yeah.
Definitely. All right. This next question asks, they kind of say that the 3 property rule explains that you can't, okay, let me start over. The 3 property rule states that you can't buy more than 3 properties, but is there a limit on the number of properties you can exchange out of?
No, I mean, it's kind of like the 3 property rule. I first want to go back to that. Is you're your letter will have 3 addresses on it, up to 3 addresses on it, but you can interchange that letter within that 45 days. So if you're like, oh, I have A, B, and C, I no longer want B, I'm going to swap B for this other B, you can do that on the letter. And then I just forgot what the other part of the question was. Oh my gosh. What was the other part of the question?
Let me go down and see what it said. Okay.
Oh,
is there a limit on the number of properties you can exchange out of?
No. So it's a really interesting question because I want to answer it a couple of different ways. I have clients who say, I have several properties that I want to exchange out of, but they're closing at different times. And so my answer to that is that if all 3, I'm just going to use 3 properties. If all 3 properties are closing within close proximity, they can all be included in the one exchange file. It's when you have 2 closing close together and then one that's way further out. So for my files, the 2 properties that are closing together, if they're closing, your exchange clock begins the day that first sale closes. Right? So that's the first property that would start the exchange file. Then you have your 45-day identification window. So as long as property 2 and 3 is closing within that 45-day window, you can use those properties in one exchange file to purchase maybe one property or multiple properties in the exchange. But if that third property is closing further beyond the 45 days, then I have them open up a separate exchange file, and that file has its own exchange time frame. But those 2 exchange files can still purchase the one property. So you can do that. It just depends on the timing. And you want to make sure that now with those 3 properties in the one exchange, does the value of those 3, what does that look like? And how much does that mean I need to buy in order to satisfy my exchange and defer paying all of the capital gains tax?
Right. The next question says, for the primary residence where part of it is rented out, such as in a 2-family or a duplex, is it just calculated based on the square footage? What if the owner never reported rental income on their taxes?
Well, then,
Not a rental.
then you're kind of, you're kind of out of the water there. So it all boils down to how you've been reporting that property. You want to make sure that you've been doing it on the up and up and that you have a clear paper trail for accounting purposes and tax purposes on that property for it to qualify for an exchange.
And Megan, does it matter if you rent out the other side of the duplex to a family member? Does that disqualify a 1031 exchange?
So usually, no.
No, okay.
Yeah, and where it gets tricky with family members is if you're exchanging to and from family members. So the general rule is that you can exchange to, but not, or you can sell to, but not buy from a family member. So you can't just keep it within the family and everybody's deferring the tax.
Yeah. Interesting. Okay.
Right. So this was a little situational question as well. They ask, if a couple were getting divorced and are looking to sell now before the divorce is finalized, can one party qualify their half of 1031? They said, I know as mentioned with the partnership, you need to separate the interest prior to signing, but if the divorce isn't finalized, can it be done?
That you can go ahead.
My thought on that is, okay, number 1, talk to your CPA, and then number 2, it's your personal residence. If it is your personal residence, there may not be a need to do a 1031 exchange. If it's a rental, then I would say talk to your CPA, and you could probably do, one spouse wants to take her 50% and exchange it into one thing, the other could exchange it into another.
Yeah, I mean, if you have, in that scenario, if everyone's on the board, same page, and it's been agreed upon about like divvying up the assets before the divorce has been finalized, then I would say there would be 2 exchange files. So it would be the husband, if they're both deciding to exchange.
Right.
So if they're both deciding to exchange, then it would be separate. So they would need to figure out maybe change the vesting. So I would basically change the vesting on how they hold title to the property so that each one has its sole and separate undivided interest in the property. So John Smith owns 50% as his sole and separate. And then, yeah, but then sole and separate, you have to show that, and it gets complicated.
You might run into timing issues on
Yeah.
that. But I think you could, well, talk to an attorney. An attorney might advise you, okay, set up an LLC.
Right.
Move the LLC into 2 separate properties with the understanding that in a year or 2 timeframe, basically you're going to just tick out the interest into the 2 individual ownership interests. That's pretty complicated stuff, and it requires a lot of
pre-planning for sure.
Pre-planning and work to kind of make that happen. I think it can be done. I just think an attorney, definitely an attorney, is going to be needed to kind of cross all the T's and dot all the I's.
Right.
Perfect. All right, the next question says, if you purchase a property with a 1031 exchange, then years later convert it into a primary residence, do you then owe the capital gains tax?
No.
Nope.
Mm-mm. There wasn't a sale. So it was just a conversion based on how you report the property.
Megan, is that true for people selling a rental in California and buying in Florida, for example? Because I know California has some pretty like aggressive clawback.
Yeah, well, yeah. But that the clawback really comes when they are selling it outright.
Sell it, not when they transition it into.
Right, not if you're converting it. So it's when, and other states I feel like are falling in the same line as that. But basically with the California clawback, it says if you owned California property as an investment and you ended up buying something in an exchange across state lines, that's okay. And you have to file a form and show the California Franchise Tax Board that it's still part, or you're still holding onto this property, reporting it as a 1031 exchange every single year. And they're waiting for the moment that you decide to just sell that property outright, because then California says, well, then now I'm going to come back and claim a portion of my taxes that you should have paid me if you had never done an exchange. Yeah. So, yeah. But just by converting it, that does not raise a flag or cause a taxable event.
Okay. This next question says, if I have a apartment in the house that I currently live in, could I use funds from a 1031 sale to buy the apartment to rent it out as a 1031 exchange property?
I'm gonna have you repeat that. You cut out in the first part. And I didn't.
Okay, sorry about that. This person says, if I have a side apartment in the house I currently live in, could I use funds from a 1031 sale to buy that apartment to rent it out as a 1031 exchange property?
So well, an apartment you don't own, you lease unless it's in a different state. So I'm not sure what we're actually talking about here.
If they have a side apartment, like a mother-in-law apartment, then they already.
Yeah, I was a little confused on that one as well, but maybe if this person is still here, maybe they can send a clarification message to the panelists. Let's move on to the next one. This person asks, how does the 30-year lease hold interest work?
Think of it like a rancher or somebody who owns land, and then somebody wants to have a ranch and basically use the land. So you have a leasehold agreement that says that you can use my land for a term of 30 years. And so basically that agreement has value to it, and that would be exchangeable.
Is the minimum lease 30 year?
30 years. Mm-hmm. It has to be at least a 30-year leasehold.
Good.
That came when I worked up in Santa Barbara, that would come across my desk several times. I just haven't seen that since I've been down in Camarillo, but that does happen.
Cool. Okay, so this person is asking for a little bit of clarification. They ask, if you can show good intent and have a paper trail, as you explained it earlier, can you then go after different properties as long as you close before 180 days?
So that really boils down to the risk. So if you have something in writing and you have that identification letter in place and you've had every intent, you have the clear paper trail, you can continue on in your exchange, but you have to know that if you were to get audited by the IRS, there is a risk involved in doing that, and your exchange could be overturned if they looked into it and decided that no, you didn't actually do everything you were supposed to do in the exchange. So I hope that helps clarify.
I think that was great. Okay, so the next question says, are there any other expenses deducted from the sales price to calculate the amount you need to reinvest into the replacement property?
I feel like we kind of covered that, but
Did
really,
we cover that already?
yeah. So I feel like it's the commissions, it's the title fees, the lending fees, anything associated with that particular closing. If you're paying your property and property taxes, usually those are prorated at the closing, those would be deductible. But if, like Spencer even mentioned, like if you have a water bill that you want to pay, a credit card bill that you want to pay, those wouldn't be deductible from the value.
Awesome. This is a follow-up question to the 30-year leasehold. They ask, can a 30-year leasehold transfer to a purchase prior to 30 years?
So from a 30-year leasehold to another leasehold?
Let me see. I'm not quite sure.
So I think what he's asking is if there's 29 years left on the leasehold.
Oh.
And he sell that in exchange into something else.
Well, yes, because the agreement is for 30 years, but maybe you're in year 15 of that 30-year agreement. So that there's a value to that. So that agreement is the duration of what you agree to. And there's a value, you're paying that. It's almost like you're renting the land.
Yeah.
So that's what the agreement is. So whatever is remaining, and you've determined what that value is at that point in time, that would be exchangeable.
So to clarify, Megan, the initial leasehold needs to be 30 years or more.
Yes.
And so let's say in year 29, so there's 1 year left in the lease. Let's just say there's 1 year left in the lease. He could sell that 1 year lease to somebody else who really needed that land for 1 year and take those proceeds and exchange into something else.
Yes.
Even though it would probably be
that not
1/30 of the total
yes.
value, right? You know,
if we're talking hypothetically, yes.
Right. Okay.
Okay. So the next question is a little situational as well. It says, if I sell $1 million property, do I have to buy at a minimum? Okay, let me start over. I'm reading this incorrectly. If I sell $1 million property, I have to buy at a minimum $1 million property all cash, correct? What if I buy a $2 million replacement property with 50% LTV debt? Can I refinance sometime later and pull out some equity?
Good question.
Yes. Well, so, okay. So you're selling $1 million and then you're buying something that's 2 million. And then eventually you want to refinance. Yeah, you can do that. Where you don't want to refinance is when you're about to sell or exchange your property. That's where refinancing becomes an issue. No. So, but if you're refinancing after you've owned the property and you're going to continue to hold on to that property and you're just trying to get a better rate or pull money out, you can do that. You can do that.
And that does not trigger a taxable event.
No,
it's like,
no. If you were to refinance and pull money out right before you exchange, that would trigger a taxable event. Yeah. But not once you've owned the property and you're just trying to get a better financial scenario or situation for yourself.
Right.
That does not trigger anything.
Great. Okay, so this is, we have 3 questions left. This first one is a follow-up from an earlier question, actually. Spencer kind of answered this one about 401ks. They kind of alluded to that question by saying, you said that a 401k owner could sell without tax since it's a tax-free entity. So could you transfer your asset into a 401k and then sell to escape the tax?
So let me just direct you. I think this is a better question for a custodian.
Yeah, that's not an exchange question.
But if I don't think, so there's contribution limits to your self-directed retirement account. I don't think you could, have $12,000 in your self-directed retirement account and then transfer a deed of a home worth $800,000 into your self-directed, because you are outside of the limits of your contribution. So my gut feel is no, that doesn't work. But I would say find a self-directed retirement account custodian to get the why and why not on that question.
Cool. All right. And this is another question that we may have kind of covered earlier today. They ask, when you buy a property that is, okay, let me start over. Do you have to buy a property that is equal or greater than my equity in my sold property? Is that correct?
So you're looking at 3 factors. So that, I feel like that question, they might be a little confused. So I want to go back to that slide. If you're trying to defer 100%, you're looking at the value, you're looking at the debt, and you're looking at the cash. 3 separate factors. And those 3 factors need to be equal or greater in the purchase. So you want to make sure that the value is equal. You want to make sure that the debt that you paid off is equal. And you want to make sure that the proceeds that are being held are being not equal, but they're being all reinvested into that new property. And the only part that you can switch out is not switch out, but you can bring in your own money and offset the debt. What you don't want to do is take on more debt and then pocket the cash. But that's if you're trying to defer everything.
And the value has to be equal or greater.
Yes.
When you replace debt.
So, but if you buy down, by buying down in value, that doesn't jeopardize your whole exchange. So I want to make sure that I'm very clear about that. It just means that you do have some kind of taxable event. So you can absolutely do that if that's what your goal is. Like, that you want to pocket some of those monies and that some of those monies will eventually be used to pay tax. That's okay. But if you're trying to do everything to pay 0 taxes, then you need to make sure that those 3 factors are equal or greater.
So no more questions left. We want to thank Megan for her time. Megan, you have this gift. You're a great communicator. You have this gift of taking something so boring and complicated and making it educational, entertaining, and easily digestible. So we want to thank you for.
Thank you. I try. So I mean, I've spent many years trying to do that. So I hope I'm coming across that way. So thank you.
As a reminder, on-demand recording of this webinar will be on our website at millcreekcommercial.com. We sure appreciate all of you who joined us today, who listened in, who participated. Thank you so much for your questions. We sure appreciate it. And we'd just like to say thank you and wish you all a great rest of your day. Thank you so much.
Yes, thank you very much.
Thanks, everyone. Have a good day.